Hey all, Happy New Year. It's now 2019, and which also means that 2018 has ended. With the end of 2018 and the end of a quarter also means it's time for a quarterly update on S&P 500 earnings and price information. I'm going to give you a lot of this data so you have an idea of just how much the index's price performance really is comparing to earnings performance, and what I expect the index to do with earnings over the next year. I don't expect these to be completely perfect, um, very up to date, because I usually only look at forward expectations once every quarter, whenever each individual company updates its earnings. Those are subject to change though, and I do expect some variability on that. However, these should get you in the ballpark of what we should expect over the next quarter, the next 6 months, next 9 months, and next year. At least on the earnings side. Price performance, it sometimes has a mind of its own, but we'll get on. I'm going to go into more detail on that and what's really gone on over the last quarter. So bear with me. I'm going to bring you to my slideshow and give you an idea of what we're looking at here, okay? All right, so it's again, this presentation is going to cover the fourth quarter and the end of year results for 2018 for the S&P 500. These are the areas I'm going to cover. Want this more to be of more interest to TSP participants specifically, though. Again, investors who look outside TSP, maybe through IRA accounts or whatever, might find some use out of this information as well. All right, so I'm going to start with index-wide performance results. That's always a big important one. And then I'll go over sector by sector earnings, how they actually performed versus what I expected at the beginning of each of the quarter. Then I'll move on to the index price targets and valuation levels. Those of you who are in my TSP group on Facebook, these are the same numbers that you're going to find on my announcement post. However, on this one, it'll be just a price chart with price points drawn on there to show you where the price really is versus where I think it should reasonably be. All right, and after that, I'll go over the index forward earnings growth projections, basically what to expect over the next year. That goes hand in hand with that previous slide there. Yeah, and you'll see all that in one comprehensive thing for the most part there. Then I'll give you a table that shows how the S&P 500's price has actually performed over each quarter, 12-month, and 24-month period, and compare it to how earnings performed over those same periods. After that, I'm going to go over some bond yield information for you. Those are always important to know. A lot of you don't understand the importance of the bond market and how it impacts stocks. I'll go over that in some more depth when we get to those. Then after that, I'll go over the quarter 4 constituent changes to the S&P 500. It's very common for companies to get replaced in the index by other companies, usually like up-and-comer kind of companies. So these are always good information for you, because there's always concern for an inexperienced investor to wonder, what if this company that you're investing in is going bankrupt? Then you just lost all your shareholder value. But when it comes to index funds like we're dealing with in TSP, it's a completely different can of worms. You got 500 different companies, 505 different symbols. 5 of those companies have 2 share classes, by the way, in case you're wondering about that. Now those, what's going on here? Okay, so if a company were to go bankrupt or basically shrink too small to fit the criteria to stay in the index, Standard & Poor's will replace them with another company that is more appropriate to stay in the index or to be added to it. So these kind of changes always go on. It's pretty common to see about 24 of those constituent changes each year. And I'll get into that more in a little bit more depth when we get to that slide. But that's kind of why that's an important information for you to know. Mostly to wrap this up, I'll go over our sector earnings breadth, both trailing and forward earnings data. What you're looking for there is to see how much of each sector in the index is participating in the growth. The more breadth there is, the more companies in each sector or in the entire index will actually be participating in the growth trend. When the breadth gets weaker, then we're on a more shaky ground, or we'll have more reason to be concerned about what's going on economically. All right, and sector dividend stats, and I didn't add it in yet, but there is a new one that I just put in also. All right, I'm drawing a blank on what the slide was, so I'll just say the heck with it, and I'll surprise you when you get to that point. When we get to that slide, you'll see it. All right, let's move on here now. Index-wide performance results. This shows, since I've been recording this data in about the second half of 2015, you can get an idea of how the index has performed in earnings each quarter since that time, since I first started doing this data. This darker orange line here is the most recently reported quarter. I mentioned in the last slide there are 505 total stock symbols in the index, 500 companies. 502 of them reported earnings, or I have data for them as far as when they actually reported earnings between October 1st and December 31st. I don't really care what fiscal quarter they actually reported for. I'm more interested in when did they actually report. Yeah, I'm looking in a 3-month window, and I want to know what companies that actually did report earnings during that 3-month window had to say about their earnings. So there are a little bit of differences between what you're going to get out of this information here and what you might see elsewhere, like on maybe Zacks.com or other sources. But they're going to be more or less similar in their numbers. They're just, just to explain a little bit of variability. That is why there's going to be some variability. Also, this is all what you call non-GAAP earnings data, or generally accepted accounting principles. For those of you who aren't really familiar, GAAP, GAAP, is basically, it's like a transparency rule. Companies are required by the SEC to report, report all their earnings. They have, they might have variabilities in how they actually do report some of their stuff, but they have to be transparent. They have to explain to investors, all of their earnings and expenses, for pretty much. They don't want surprises like Lehman Brothers or Enron and whatever and stuff like that happening to investors anymore. And they have protections in place to prevent that. But as much as the GAAP earnings data is useful for that purpose, it's not so great for making good apple versus apple earnings comparisons, because a lot of times there will be like a irregular or one-time income or expense of some sort that a company might report that affects the way their earnings look relative to the same quarter the previous year or in previous years, whatever. So non-GAAP earnings, what that does is strips out the irregularities in it and looks at like basically a one-for-one comparison of what's going on the earnings front. Anyway, it's enough of that explanation. What we saw here in the fourth quarter was very strong earnings growth. It had 32.25% year-over-year performance. So what that is comparing this 810.73 to the 608.13 in the fourth quarter of last year. This is a very strong performance, and as you see through the entirety of 2018, we had really good numbers. Almost 17% in first quarter. Now was the weakest growth we saw in the whole year. 27.25% in second quarter, just over 26% in quarter three, and in this quarter we saw 32.25% growth. This is very strong growth. This really helps out on the bottom end of, or the back end of corporate earnings or index-wide earnings, and helping with increase the index's overall valuation level, or what is actually reasonable. Also, with the breadth, again, I talked about breadth in the previous slide. There are 505 symbols, 502 accounted for, 436 of them reported positive growth. This 86, almost just about 87% of the entire index reported positive earnings growth. 2 of them reported about the same, and then 64 reported negative growth. As you see, if you compare it to all these other quarters, this is the strongest positive breadth that we've seen yet since I've began tracking this information. The weakest we've seen since I've been doing this is first quarter of 2016 at 52%, and now it also happened to be the only quarter where we saw negative earnings growth over the across the whole index. You might look back at that point in time, and other sources might tell you there were a couple of quarters of negative growth index-wide, but again, there are variabilities in what kind of earnings data they're looking at, how they weight their information, and things like that. I'm just doing kind of across the board, add everybody up. It's not necessarily going to be an accurate representation of weighting, but from my experiences have been with this information, as long as I do it like this, I've always had very good, accurate valuations of the index. I have seen variabilities in price relative to what this calculation method uses, but it always reverts back to right in that neighborhood of what my data says. Okay, next I want to show you end of year totals. To the end of 2016, we had index value of 2138, and end of 2017 it grew to 2306. That was a 7.87% growth rate last year in 2017, and this year it's grown to 2912. So, and it basically a non-growing earnings environment where there's no growth or contraction. 2910, 2900 to 2915 perhaps is actually what I would consider a reasonable price level for the index at the moment. And remember, the index is trading way below that right now. It's at 2506, I believe, if I recall, which is a considerable amount below where I think it can reasonably be. So right now, what that's telling me is that current price performance is pricing in declining earnings over the next year, and not positive or flat growth like we're actually expecting positive, and you'll see that pretty soon here. So there's quite a disconnect between what the price is actually doing and what I think it should reasonably be doing based on earnings. 26 and over 26.25% earnings growth over the last year. That's a very strong year. I would gladly see something like that every single year. I mean, you will see some very, very fast growth like that. If you use a rule of 72, basically take 72 and divide it by your average annual growth rate, and it's a simple growth rate when you're using the 72% rule of 72. I mean, and not compounding. Let's just say if it grows at 24% per year at a simple average rate, then it'll only take 3 years for what money you have invested to double. So that means if you have like a $100,000 retirement account or a TSP account, whatever it may be, and you don't invest another dime at all in it, if it grows at a rate of 24% every year, it's only going to take 3 years for that $100,000 to turn into $200,000. So if we see price performance match what earnings performance is doing like this time, that's the time you really want to make sure you were invested in stocks. Now, the last quarter, as you saw, was a huge disconnect between price performance and reality. That's unfortunate. Investors their views are clouded by a lot of the things that are going on, particularly questions about how tariffs are going to impact the economy, whether or not the Fed is being too aggressive in their interest rate hike policy, and also the U.S.-China trade relations issues as well. I think those are all valid concerns. However, I do also think investors are blowing all those concerns way out of proportion, um, to the point it's completely ridiculous. You know, I say the earnings are already there. We're still expecting more earnings growth over the next year. We should not be seeing prices down where they're at right now. It should be quite a bit higher. All right, that's enough for this slide. Let's move on to the sector by sector earnings, actual versus expected. There are 11, okay, out of those 502 or 505 companies, basically they all break down to into 11 different sector categories. So, these are the 11 sectors here. These are the number of companies in each sector that actually did report and how many are total in that sector. As you see, all but one consumer staples company, one industrials, and one material sector company reported. One of those companies, LIN, I forget the name. I'm trying to blank on the name. They're a new addition to the index. They don't actually have earnings, past earnings to report yet, and I don't have any information yet on when they're going to report earnings for their first quarter or whatever. So that's one of the wild cards there, why we didn't see 505 reported this quarter. There are two other companies that last reported in September, and they aren't reporting until I think it's this week coming up. So their previous and next earnings data doesn't fall within my October 1st to December 31st guideline as far as how I calculate all this information. But it's still 502. It's a significant portion of the index. And what we see here, this is what the sectors have actually done. Energy and financials had very, very strong earnings growth performances. And particularly, they were both quite a bit higher in performance compared to what I originally expected from them. So this column here tells what I was expecting them to do before the quarter began, and this is what they actually did report in performance. So as you see, not a single one of them reported basically underperformed their expectations. In fact, quite a few double-digit beats, and the weakest one we can even find is consumer staples at about a 6% beat. Another really notable one here is the real estate sector. Scotty Cox, you're going to really love this one. I was expecting negative 8.15% earnings performance from that group in the last quarter, but what they really delivered was better than 22.5% positive growth. It's a 30 and 2/3% beat on what was expected. So the only sector that had any expectation of a decline beat by a very large amount, actually third best beat percentage out of the whole entire index. So very strong growth here. Index-wide beat, as you see, I was only expecting about 14.33% year-over-year growth over the last quarter, and it more than doubled that. Is what we really got, over 32%. Again, these are the kind of numbers you really want to see as an investor every quarter over as much as possible. Much better than expected earnings performance, and the more let's hope it stays that way. The next quarters are going to be slower growth expectation, but again, if they continue to outperform like this, we will have no problems at all seeing record highs in the next over the next year. All right, index price target valuation levels. This is where I was talking about where this is basically the information that I have in my announcement post in the TSP group, and this is more of a visual representation of it. So right now, if we had zero growth at all, the white line here, baseline current value 29.15ish, is where I would expect the index to be reasonably priced or reasonably trading. When there's positive growth, though, this yellow line here is what tells where I'm expecting the index to be valued at a year from today. And that would also be in a zero growth environment. So And the next year, I'm expecting this white line to climb up to where this yellow line is. As long as that keeps going on and the forward expectation remains neutral or positive, we should continue to see share prices grow as well. This red line, this red slanted line here, kind of gives you an idea. Earnings, basically earnings and actually price performance has channeled that, but it's also a good, pretty decent representation of what kind of earnings growth we had before as well. You see right back here in October, right beginning of October is when things went completely south, which has also happened to be right at the beginning of the earnings reporting quarter, and when a lot of companies were just starting to report their updated earnings and expectations. You see, it's been, what I just showed you, 32% quarter-over-quarter growth, or year-over-year quarterly growth, and why are we seeing prices drop then? If it was that strongly positive, then these prices should have been going the opposite direction, if anything. Now, what I consider a reasonable trading range based on current earnings, these red lines here and the green lines here, basically this range here is where I think the price should really be reasonably at right now, based on the current earnings, both trailing and forward data. But as you see, it's considerably lower than that. So it's not only below the neutral point, so they're pricing in declining earnings over the next year when current expectations don't even call for that. So yeah, there's quite a disconnect, and also all the stock indexes, or most all of them, actually did fall into what we call bear market territory, which is defined as a 20% or greater drop with that lasts at least 2 months, and we had just enough out of the S&P 500 to get that. A little more than that on the S fund, or the Dow Jones U.S. Total Completion Index. And I don't want you confusing that U.S. Total Completion Index with the Dow Jones Industrial Average. Way different index by a mile. Dow Jones Industrial Average is only 30 companies in it. All 30 of those companies are also in the S&P 500. These are all large cap only companies. There are no funds in the TSP that invest in the Dow Jones Industrial Average. It's not a bad indicator to look at, but as far as practical comparisons of stock indexes versus your actual TSP accounts, it's virtually worthless. You're better off paying attention to the S&P 500. It's been the standard for professional investors to use since the 1980s. I want to say 1988 or so is when it became the standard. Also, the C fund in the TSP specifically follows the S&P 500, so that's why and it's a lot easier for me to obtain the data that I need to come up with these analyses and valuation targets and all that. S fund, which follows the Dow Jones U.S. Total Completion Index, much different index. It has 4,000 plus companies in it, and they come in all forms, all sizes, from large cap all the way down to micro cap. So, and it is more more small cap oriented, but it does include all sizes. Either way, this is very telling that price performance is very far disconnected from reality as far as earnings are concerned. And usually, if you follow earnings, and just stick with what the earnings data tells you, there's a darn good chance you're gonna make better, more well-informed, and smarter investment decisions. You won't be so inclined to panic sell just because you see your account balance dropping from these share price drops, because in reality, it should really be up here. This is so far detached from reality that Mitch Zacks from Zacks.com, which by the way is a very excellent finance-related website and investment-related website, I should say. He was even saying recently that this is the first time he's ever seen stock indexes fall into bear market territory without any kind of expectation of economic recession to support it. You know, we got positive earnings growth expected, not negative. So again, and he's been doing this. He and the other guys at Zacks.com have been doing this for years, and they've seen many recessions, many bear markets, and they always go hand in hand with each other. This is the first time ever he says he's ever seen this. So this should help illustrate just how irrational the market actually is right now. And you don't be in line with those irrational investors and traders. If you follow the irrational crowd, there's a much stronger chance than not that you're going to get burnt. You're going to either sell out at a low price, and price is going to whipsaw back up without you involved, and you'll have to get back in at a much higher price. Or you could sell out of your shares too early, basically while they're on the way up. Anyway, I think it's enough rambling on that. My point here is stock prices are considerably below where they should ideally be right now. Moving on, this is mainly so you get an idea of what to expect over the next year. And this kind of illustrates also the chart you just saw. 2913.64 is what I have the index actually valued at right now. So 2915-ish, you know, if you round to the nearest 5, is about where I'd expect the index to be trading in a zero growth environment. And again, it had 32% in earnings growth. Next quarter should have some more double-digit growth coming. Another 14.7% is what I expect to see or at least year-over-year growth. What I expect to see next quarter. It should be a 3.31% increase as far as the 12-month figure is concerned. It should also raise the baseline value of the 2913 level up to 3010, which is the 96 point increase in its expected value. So that white line you saw in the previous chart, if all goes as planned or as expected, it should climb from 2915 all the way up to 3010 by the end of March. Again, this is very positive, and the more positive that is, the more you need to stay invested in stocks. Then the following quarters beyond that, get another 50 points increase in the second quarter up to 3060. That'll be just over 5% growth over today's current earnings, and it'll be about a 7.3 growth rate, at least as far as that particular quarter compared to the same quarter in the previous year, or the second quarter of 2018, basically comparing that to second quarter of 2019. Third quarter of 2019, expecting another 70 to 75 point increase in the baseline value, which should get us up to the 3130, 3135 level. It'd be about a 7.5% increase over today's current earnings, and just about 9.75% year-over-year growth. And a year from now, hopefully it'll be up to 3180. That's what my current projection is. Again, this is subject to change as each quarter progresses. So we'll see how this progresses every quarter from here. But right now, my target is 3180 a year from now, and that'll be a 9.17% growth rate over today's finish. It's definitely a lot slower than the 26% growth we saw in 2018 over 2017 as a whole. But this is actually a more reasonable growth rate. It's nothing to be concerned about. I'll get more into that in terms of how it relates to bonds when I get to those bond pages, those bond charts. All right, then fourth quarter of next year, it is supposed to be slower, right around 6% year-over-year growth. Very strong standards being set in 2018 makes for more difficult standards to exceed in the next year. So keep that in mind. Just because the growth rate's slower doesn't mean that stocks are going to fall off a cliff and stay that way. There's no reason they should even be where they're at right now. But again, there are plenty of reasons for that, why investors are overly cautious, I'll say. Some concerns are maybe legit, some are not so legit. All right. Anyway, historical price versus earnings data. So here's what I have for since I've been keeping track of all this information here. The left side of the page shows how the index the price has actually performed over each quarter, over a 12-month period, and then over a 24-month period. The more we go over a long-term period, the more we can smooth it out and see just how well the index really is comparing to actual earnings. The right side of the table here shows the earnings performance. So each quarter, this is what I had for that quarter. 12-month earnings, the value of the index based on that right here. Year-over-year performance, basically comparing each. What it does is like this 584 is comparing to the 536 on the previous quarter. Or no, actually, no, I'm mistaken. 584 is comparing to the 558. You got to compare the same quarter against the same quarter the previous year. Companies tend to be cyclical in their nature as far as when they earn what kind of money or bleed what kind of money. Great example of this is H&R Block. I always love to bring these guys up because tax season, I think for first quarter of each calendar year, they have very, very strong earnings, strongly positive earnings reporting, but all three of the other quarters are usually in the red. But as a whole, their overall earnings over the course of the entire year, once all said and done, are usually always still in the black. In other words, they're still making money, even though three of the quarters they lose money. It's not a fair comparison to compare three bad quarters against one good quarter. Not when it's always the same good quarter. The same quarter is always the good quarter. So that's why we go by year-over-year performance. Also, same thing, got 12-month earnings growth and then 24-month earnings growth. So the main takeaway here is looking right here at the 24-month trend. We've been mostly in the high 20s up to maybe mid 30s range, somewhere in that ballpark. The first quarter I was able to actually have a good 24-month figure to work with was right here at almost 29% just last quarter. And with today factored in, it's at plus 36, almost plus 37% over the last 2 years. That's very strong growth. You don't want to be missing those that kind of growth. And that's in the right ballpark of what the price, the index was actually doing over the last year. So that's a good sign. But now what we have here is it dropped. The price dropped so much, dropped 14% over the last quarter, and over the last 12-month period, the price is 6.25% lower than it was previous year. Basically, 26.73 fell down to 25.06. And over the 12-month period, as you see, it's grown still. You've still made almost 12% overall growth, or roughly 6% per year over the last 2 years. If you were a buy and holder in the C fund through all that time. But again, as I said, that's detached from reality. This information here and what we still expect from earnings over the next year at least should tell a lot more about what this should really be doing. So expect stronger growth to get prices back to normalized levels once all the geopolitics and stuff resolves itself. And I'm not going to get into all that stuff. I don't care what anybody's opinion is. I'm not going to give you mine. It's it is what it is. Trump administration has its strategy. They're doing what they can with it. Not saying whether pieces of that strategy are smart or not. It doesn't matter. It's beside the point for me. All I care about is I want my money to increase in value. And based on the numbers that I see here that are completely independent of what goes on with any politician in office, this tells me that share prices are making up a lot of problems that don't really need to exist just yet. Now they're pricing in quite a bit of a drop again. All right, let's move on to the bond yield data now. I'm going to give you a third quarter bond yield curve and then the fourth quarter after this, so you can get kind of an idea of just how much they've actually changed over the last quarter. Now this is a fairly normal looking bond yield curve chart from the end of third quarter. What we're looking for is we like to see the short end here at lower rates than the long end over here. It is climbing upward all the way across. There are some areas of flattening, like say the 2-year, 3-year, 5-year neighborhood, maybe even 7 and 10-year area, but it's still a positive curve chart. It's not a very strongly bullish curve chart, but it is still bullish. Now also take mind of what the interest rates are right here. It's got 2.12% on the short end and then 3.19% on the 30-year and 3.05 on the 10-year. 10-year is the one you really want to pay most attention to. 10-year is roughly about the level that the G fund is going to grow at, basically. So if the 10-year yield is at 3.05%, then I would expect the G fund to grow somewhere in the same neighborhood. It might grow a little faster, just a hair, because what the G fund is it grows at the rate of all bonds that have maturities, remaining maturity length of at least 4 years. So it only factors in the 5-year, 7-year, 10-year, 20-year, and 30-year bonds. And once any of these bonds get to where they have less than 4 years left on them, they are no longer a factor in the G fund's growth rate. So the more recent bond purchases, in a way, will have a greater impact on what the G fund's growth rate is going to be. Also, in a growing interest rate environment, I don't recommend being in the F fund unless you're putting new contributions into there and basically dollar cost averaging new shares of it. I would not be moving existing money into that fund just yet until we know for sure that bond yields are going to top out and recession will actually begin. Also, there's more to that we'll get to on another slide here, a couple slides from now. But anyway, let's go to the quarter 4 bond yield data. As you see here, it looks quite a bit different. Definitely not as bullish. There's definitely several spots here where particularly the 6-month and 1-month bonds here look like they've inverted relative to some of these longer ones, like the 2-year, 3-year, 5-year, and 7-year, maybe even the 10, or well, no. 1 year is at 263, the 10 is at 269. So it's a very small gap between the 1-year rate and the 10-year rate at the moment, but it's still positive. It still favors the 10-year. For those of you who haven't seen previous videos about this from me, or previous posts from me about this, I'll put this in a nutshell. Basically, banks and governments, they borrow money at the short end, and they leverage their profits by lending money out to people on the long end. But when the short-term rates get so high and long-term rates get so low relative to the short-term rates, the thought is that it becomes no longer cost-effective for the bank or the government or whatever to leverage their growth by borrowing money in order to lend it out to someone else and get more revenue out of it. But this is only part of the overall bond picture. I'm not even bringing up other countries' bonds that U.S. and U.S. banks could also be getting involved with. A good example here actually is German bonds, what we call the Bundesligas or Bunds. That's basically Germany's version of the U.S. Treasury note. Right now, their 10-year Treasury note is at a negative yield, not positive. So they're still trying to stimulate their economy more. Between that and currency exchange rates, banks and governments are, they have people who do a lot of deep analysis on this, and they know how to arbitrage this. If they know that there's an opportunity for them to arbitrage by borrowing from the least expensive overall source and lending it out to, at the longer end, to their borrowers, they're going to do that. So even if we get an inversion on our own bond yields here, it doesn't necessarily mean that we're going to see a recession in the near future. There's a lot more involved in that. Like I said, foreign bonds, foreign currency exchange rates, um, credit default rates, which actually, now that I think about it, is the last slide that I added into this one that I didn't include in the table of contents. Things like that. But the last I heard was that banks are all saying that they have plenty of liquidity and they have plenty of opportunity still to use the bond yields to their advantage, and leverage their profits by more borrowing on their own to do more lending on their own as well. So that's all positive. Just got to get the rest of the investing world to recognize that and or be made aware of it, so they know that banks aren't just going to start curbing their lending practices right away. Because I say that as long as it's cost effective for them to keep borrowing on the short end and lending it out on the long end, they're going to keep doing it. And the more they keep doing it, they're going to keep stimulating more business growth. It's not just consumers maybe buying homes and getting 30-year mortgages that are fueling bank profits. It could also be businesses that are trying to grow their own profits, and they need to borrow money from banks to invest in their own growth. As long as banks are still in a position to lend that money out to them, then those businesses are going to continue to borrow the money to facilitate that growth. It's when banks stop lending it out so much that we're going to start seeing more stalled growth. But at the moment, that's not even on the horizon just yet. So I wouldn't worry too much about this. Yeah, we do have a little bit of inverting going on, but we don't even have an inversion yet of the 2-year and 10-year, which is a commonly looked at one. 2 years at 245, 10 is at 269. It did that gap did get as tight as about 11 basis points within the last quarter, but as you see, it has grown back to about 24 basis points or so at the moment. So I just want y'all to be aware that right now we don't need to be worried about bond yields, even though the media and some people in the market will have you believe otherwise. Don't fall prey to their little tricks or paranoia. If you make smart decisions, you're not gonna, but you might take some short-term losses, but you'll make longer-term gains because of it. All right, comparing bond yields versus stock earnings. This basically gives an idea of how much I think you should, if you want to have a diversified distribution, or at least something in stocks and at least something in bonds. This is basically a representation of how much I think you should consider having in each stocks and bonds. Right now, the S&P 500's forward 12-month earnings expected yield is about 9.17%. A 10-year Treasury note, as you see, dropped from 305 to 269, which means bonds are less attractive now than they were just last quarter. Last quarter. So, but either way, the comparison here to me is that you should, if you want a diversified distribution, you should probably consider having about 75% of your assets in stocks and the other 25% in bonds. Like I mentioned in the previous slide, the 25% in bonds, if you're going to put it in there at all, I would put it all in the G fund. I would stay away from the F at the moment. As far as stocks are concerned, definitely stay away from the I fund. Foreign growth has been slower. I mean, it already has been slower all year long, but it is showing some signs of weakness, while the U.S. economy is not really, has been much more strong in its growth, and there's still plenty of demand from at least that's showing up in economic data. And more of that demand's coming from domestic sources than from from foreign sources. So I would recommend you keep your stock funds or stock money, whatever, in the CNS funds. Doesn't really matter so much which of the two. Just know that the S fund tends to be more volatile on both ends. Tends to lose more on the drops, but also gains more on the rallies in general. Also, I think with declining global growth or foreign demand, it's going to impact the larger multinational companies more than the domestic companies, if you ask me. So, in other words, that's going to impact the S fund companies less than it will impact the C fund companies. However, with bond yields, whenever it does get to the point where banks start to tighten a little more on their lending practices, yeah, now that will more likely harm the smaller companies than the bigger companies more, because a lot of these bigger companies have huge amounts of cash flow, might even be operating completely on cash, may not even have loans, so they're not in any position to be worried about it. They might have the capital on hand on their own to continue to grow their own business. Smaller companies tend to need to rely more on those loans. So yeah, it's kind of at somewhat of a crossroad here, I guess I would say, as far as whether I'd more heavily favor C fund or more heavily favor the S fund. I honestly don't have a really good answer to give you on that. All I can really say is, I don't know, maybe consider putting 50% in C, 50% in S, if you're going to be 100% stock funds, or split, whatever the case may be, split your money between C and S funds and put the rest in G fund if you're going to have anything at all in bonds. But that's more or less where I think you should be at the moment. I'm always for staying 100% in stocks as much as you can tolerate having the volatility in the prices. But if it's too much, but you still want to have something that's somewhat sensitive to the economy, then I would go with the 75-25 distribution, and then check again at the end of next quarter. This will change every quarter, and you'll see it progressively become more of a more biased toward bond distribution as stock earnings yields drop and bond yields climb. So when it does get to that point where recession really is much more likely, by that point in time, you'll probably already have a larger portion of your money in the bond funds and in a position to avoid whatever drop might come with that. Again, this drop we just saw in this quarter was more of a fluke than expectation. Some other people might say otherwise, but again, they tend to have more narrow views. I'm not saying they don't have good points about their concerns. A lot of the times they do have valid concerns about things, but a lot of times they are blind to certain other details that make a big difference. So that's all I mean by that. And I was taught by very good experts, always follow the earnings. If you follow the earnings, you can't go wrong. If you see a diversion from reality, then you know whether a price bubble forms or if people are irrationally bearish or whatever, or there's some kind of opportunity that you can exploit. So anyway, that's enough on that part. Let's move on. I'm going to go over the constituent changes in the index in this last quarter. This quarter, there were a total of 8 companies that were replacing the index by new companies. The new additions are Rollins Incorporated, or ROL, which is an industrials, environmental, and facility services company. Also in October, we saw Fortinet get added. They replaced Envision Healthcare. November saw Keysight Technologies, electronic equipment and instruments company. Jack Henry and Associates Incorporated, a data processing and outsourced services company in the information technology sector. You see, you got 4 of these companies out of the 8 are in the tech sector. So they're now this one is a healthcare company. I can't remember if CA was a tech or a communications company. But my point here is sometimes this is something else to consider. Back in 2015, when the energy earnings were dropping like a rock, and actually slowing down the entire index. At that point in time, there were 40 different 40 energy sector companies in the index. Today, there are only, I think, 30 or 32 or something, or somewhere in that ballpark. There are considerably less energy sector companies now. So, and Standard & Poor's, they know what they aren't stupid. They learn lessons really, very quickly where they want to focus their attention on up-and-comers coming into the index, and they don't hesitate to get rid of companies that are underperforming, or like their market cap drops too much, and there's someone else who is bigger and is a more appropriate fit. But in all of these cases here, out of these 8, all but one of them were a result of acquisitions. So you see here, Andeaver was acquired by fellow constituent. I don't know why I said Marathon. It should be Marathon. Envision Healthcare was acquired by KKR and Company. CA acquired by fellow S&P 500 constituent Broadcom. Okay, the only one that was not a result of an acquisition was this one, EQT. They spun off 80% of their stake in Equitrans Midstream, which caused both of their, basically a spinoff is basically the opposite of an acquisition. Instead of a company acquiring another company, now one company is basically splitting off into 2 smaller companies. And in this case, the 2 smaller companies that were both too small to remain in the index, so they both got removed. Or basically the mothership company, if you will, EQT, they got removed from the index. But all these other ones were a result of M&A activity, which is that's also not a bad thing, because this means that larger companies have money to invest, and they have their sights set on other companies that they think can improve their own situations more. This is good for S&P 500 companies. So the more we want to see more of this kind of constituent change activity, more acquisitions, maybe mergers, and less of the market cap changes where companies are maybe underperforming, their stock prices are dropping, their market cap drops, and they're maybe because their earnings are dropping and now they're no longer worthy of staying in the index. So we had a total of 8 this quarter, and I didn't put it in there, but over the course of the entire year, there were a total of 22 constituent changes in 2018. So pretty close to what we typically have been seeing in previous years. All right, so this is, I just wanted you guys to be aware of this, because if you're investing in stock index funds, you need to know that stock index funds, it's very extremely unlikely that any stock index fund will ever have a bankruptcy where all of your money that's invested in that fund is going to go down the drain. It doesn't work that way. You got money invested in 500 different companies here if you got the C fund, and you got over 4,000 different companies if you're in the S fund. You have about 1,000 companies if you have money in the I fund. So in each of those cases, a company goes belly up, so what? You're going to get replaced in the index by another company that's probably in better shape. So don't worry if you have money in stock index funds. If they the share price drops, I guarantee the prices will go back up at some point in time, and more likely they're still going to go up at a faster rate over the long term than what you're going to get out of the bond funds. So this really is more of a matter of how much can you tolerate the price fluctuations than the overall long-term performance. And trust me, you'll like the longer-term performance from stocks a lot more than you will from bonds. But like I say, some of you get a little freaked out by watching maybe $1 million account drop to $800,000 in value, or maybe your $400,000 account drop down to just over $300,000 or something, or in that ballpark recently. It does happen, but like I say, prices are not attached to reality at the moment, and if you stay with it, there's a pretty good chance that all that money you quote unquote lost is going to come right back over the next several months. So I wouldn't worry too much about that. All right, sector earnings health. This is what the trailing earnings situation looks like now. The more blue you see, the more companies participated in the growth in that particular sector. and they're ranked from left to right as far as which sector had the strongest participation rates in growth. So you see, communication services had the strongest positive breadth, as I call it, while real estate was the weakest. But as I mentioned in one of those previous slides, real estate, even though I was expecting negative 8% growth this last quarter, they actually delivered plus 22% growth. They did have more, a greater proportion of their sector not report growth at all. But as you see, more than half of the sector still did report growth. I did not keep all those percentages in there, but you see, it's about 30% of the index, or, well, forget. I'm forgetting how I had these sorted right here, but anyway, more blue and less orange means there's more positive participation, which is what we want to see. Now, I was looking ahead. Let's look forward to the next quarter, what I expect. It still looks fairly strong. Utilities, not so good. It looks like I'm expecting less than 50% of that sector to participate in growth over the next quarter. But on the other hand, it's utilities. That's not necessarily a bad thing, because when we see utilities and consumer staples at the bottom end of this, and other companies like energy, financials, consumer discretionary at the stronger end, these are good signs, not bad signs. This is not what you see in a bearish economy. When the economy is about to start turning bearish, the business cycle will change to where these energy, these more cyclical companies here that are right now expected to perform more strongly are going to slide more to the right, and then these safer industries like utilities and consumer staples and maybe real estate are going to slide over more to the left. Used to also be the communication services, or what used to be called the telecommunications sector. That used to also be considered a safe sector, but with the recent realignment of that sector, where a lot of very big companies like Facebook, who else? I think maybe Verizon, if I remember right. I forget. Oh, Verizon was already there, but some companies like Facebook and some others that were previously in either consumer discretionary or information technology got moved over to communication services. So I don't think that we can really call that sector so much of a safe sector anymore. Or basically one of the sectors that is going to be the least sensitive to recessions and bear markets. That's what I mean by safe sector. It doesn't mean that they won't drop in value. It just means that they tend to be less sensitive to the effects of problems with the economy. So again, these are good signs to me. I see a lot of orange, not so much gray, and the sectors I want to see on the left are on the left, and the sectors I want to see on the right are on the right. Materials, I wouldn't mind seeing a little more further to the left, because materials and energy sector stocks both tend to be sensitive to crude oil prices. So, but you'll see there's still plenty of orange and not a heck of a lot of gray on the material sector. It just means they're not going to grow as fast, or not likely, or not necessarily going to. But a lower proportion of material sector stocks is expecting growth over the next quarter than, say, energy and financials. All right. Anyway, it all looks good and still bullish to me. Moving on here. This is a new feature I just did this at the end of this quarter. I got curious to see just how much of the index really is paying a dividend, how much of each sector pays a dividend, and how much of each sector or the index actually made changes to their dividend prices, or dividend amounts, I should say. So each of the sectors, here's how many constituents are in each of the sectors. Speaking of energy, like I mentioned earlier, there used to be 40 companies in the energy sector. There's only 30 now. So see, like 10 of them got removed from the index and got replaced by companies in other sectors. All right, so this column here, percentage of the sector that pays a dividend. If you're a dividend investor, or say, let's say you invest outside of TSP, maybe you have an IRA account or elsewhere where you might want to invest in sector ETFs or things like that. the proportion of that sector that pays a dividend might be of interest to you. And if that is, you'll definitely also have an interest in what proportion of that sector also raised or lowered their dividends. So that was the purpose of why I put this in here. It's not so much for TSP necessarily, although it is good information for TSP, because the more we see dividend increases, the more it means that we have a more solid economy. The more we see dividends stay closer to zero, like no movement at all, or maybe even some decreases in dividends, then that's an area we'd be a little more concerned about. But right now, you still see a large, all dividend growth except for just a couple of companies here. GE was one of them. I forget what the utilities company was, but GE is a well-known problem area right now. It's an individual company is an individual management problem. So that's why they slashed their dividend by a large amount. I didn't take a close look at the utilities company. I forget which one it was also. I'm not concerned about it, but what I'm more interested in is what percentage of the sector increased its dividend payment or announced the dividend that it used to not have, and also how much of the dividend payers in that sector actually increased their dividends. So you see, the financial sector looks like it has the strongest prospects at the moment. 96% of the companies in the financial sector pay a dividend, and more than half of those 67 companies, 36 of them total, increased their dividend payment this quarter. And 56% of the companies that do pay dividends also increase their dividend. So this is a very positive sign to me for the financial sector. If I was a dividend investor, it doesn't necessarily mean they're going to keep increasing their dividends over the next quarter or whatever, but it tells you that if they're increasing their dividend, more companies in that sector are increasing their dividends, they're probably more upbeat on their longer-term future, their earnings future. Because companies aren't going to increase their dividends if they are a little more pessimistic or concerned about their longer-term growth. So, just from looking at this alone, I would say the financial sector definitely looks like a good one to invest in if you're looking at if you have an interest in dividends. Real estate also. Real estate is naturally a high dividend sector, and then industrials also look like it had a lot of growth as well outside of GE. So, there's a lot of good sectors here. Consumer staples also 42% of their companies increase their dividends. Some good numbers here. You won't see so much. You're going to see these numbers taper off more when earnings start to really decline. So, again, these are still good signs, especially for longer-term investors in those sectors. All right, now the last slide I'm going to cover here was one that I just got from the S&P, from Standard & Poor's and Experian. They gave a consumer credit default report on December 18th. This information can be obtained from the S&P, spanddices.com, which is where I got my info. You see also I'm crediting them. Please visit their website. You can get a lot of good information here. But what I want you to know here is there are some what I call perma bears in the group, or out there, maybe not in the group also, who are going to tell you that the economy's in a sham and is on its way down, and then credit consumption is at record levels, whatever. Okay, yeah, in an expanding economy, people do tend to buy on credit more. And you know what? Buying on credit is leveraging your personal value or your growth, if you know how to do it. But buying on credit also means that you're stimulating the economy by making more purchases from companies and putting more demand on those companies, so it encourages them to grow more. Now, the flip side of that is, what's the consumer credit quality like? If we start seeing default rates going up, then that is an area that we should definitely have more concern with. But when when borrowing on credit is on the increase, but the credit default rates are declining, is that something you really think that we should be really that concerned about? I don't personally. In fact, if you look at the November 27 levels versus the November 2018 levels, the composite default rate was at 0.89% in 2017. It's down to 0.83 right now. For first mortgages, the default rate has dropped from 66 to 64. Oh, housing market's not doing so well. Okay, well, it's not because of poor credit. That's what this information is telling me. Credit's better than now than it was last year. There's something else going on with that housing market, and I'll go over that a little bit more on that in a second as well. Bank cards or credit cards, default rate was at 3.28%. So this tells you that the first thing that goes south when people are struggling financially is they quit paying their credit cards. And then after they run out of, after they have no more credit cards to worry about, and they get charged off, whatever, the next thing they're likely to lose is their cars. And then they'll lose their houses last. But credit cards, the default rate has dropped from 3.28 to 3.09 in the last year. And with auto loans, it's also dropped from 111 down to 93. So, again, this doesn't look like a representation of an economy that is in dire straits. This looks like a representation of a healthy economy that just had a very strong year of growth and now has a much stronger standard to contend with over the next year. That's it. That's pretty much all I have on that part. Now, I want to go back over this home mortgage or housing market issue that I just talked about. Yeah, we know there's some weakness in the housing market. What is driving that? That's the real question. I think a lot of people have this vision that what's going on with the housing market is a spitting image of what happened in 2007. Where people were buying on, using substandard loan types and borrowing with money they couldn't afford to borrow, or poor, maybe adjustable rate mortgages and stuff like that. I don't think that's what's going on right now. For one, the millennial generation, it's statistically shown that they tend to stay at home with their parents for longer before they decide to move out on their own. They also tend to have a little more trouble finding jobs or good paying jobs where they can't afford to get a home. So that's part of that. Also, because of, I don't know, maybe tariffs could have a factor in it. I don't know. But material costs for actually building the homes, it's not so cost effective for home builders to build homes as much anymore. And the demand from buyers to buy those homes is not high enough right now where the home builders are necessarily finding it cost effective to even execute some of their projects and get more houses built. They'd rather wait for the material cost to drop and increase their profit margins. And even if even if prices drop a little bit, it could improve their profit margins if the material prices drop as well. So that could be a factor in there. Also, I just saw some recent data. I didn't include it in here, but I did see a couple of things recently about, I think, retail sales. One of them showed I think jobs growth also. Jobs growth, and I want to say, I don't know, might have been inflation data or some kind of retail sales or whatever. It might have been Redbook. One of those sales and one of those job-oriented areas, though. Both of them showed something very interesting as far as real estate market was concerned. The jobs data showed there was a notable strength, at least I noticed, and jobs that were in the real estate and that kind of market. And whatever that sales, inflation, whatever it was, report I looked at, also showed that there was a remarkable increase in, I think it was inflation data, showed a notable increase in, let's see, was it durable goods, household durable goods and furnishings, consumer electronics, and appliances. What's wrong with this picture here? So consumers are buying all these big, heavy-duty products, appliances, couches, things like that you would expect to find in a house, or computers that are not always cheap. There, you might pay a good $1,000 or more for a reasonable computer. People are spending their money, and they're spending their money on things in areas that supposedly are not doing so well. This tells me there's something wrong with this picture here. There's something we are missing out on. There's something involved in that housing market that we are not getting. I'm not going to say that I have all the answers to that myself. I don't look at the microeconomic aspects of that. But I do look at enough of the other data to know there's some kind of disconnect going on there. When there's jobs growth and inflation growth in that area, but no demand in the homes themselves, there's definitely something else going on here. Something else I'm inclined to believe here also is that perhaps people they learned their lessons from 2007. Maybe they knew that they were buying homes that they really couldn't have afforded to be in and really shouldn't have been buying back at that point in time. So now they're a lot more pragmatic in their efforts to buy homes, and they might be so in other words, they might only be willing to spend so much of whatever the income they make on buying a home to live in, and they might be more willing to live in a cheaper home in return for having more discretionary income to live to enjoy. Or they can they have more money that they can spend on restaurants, vacations, other whatever other kind of travel stuff, or maybe more they can spend on Christmas presents or holiday presents if you're not a Christmas type of person, or whatever. So that kind of stuff. So what I'm getting at here is that back at that point in time in 2007, a lot of banks they wouldn't lend you money for a home if you were borrowing, your debt to income ratio, I think it was more than 40% or something like that, or maybe even a little lower if it was a prime loan. Perhaps potential homeowners are hip to that and don't want to spend that kind of money on homes anymore. They might have the money, they just don't want to spend it. They might want to spend it on other stuff where they aren't so obligated and can be a little more flexible in how they spend that money. So that's just a theory I have on what's going on with that real estate market. If any of you have a more solid background in that area, I'd love to hear some of your expertise in that and share some of your thoughts. But that's anyway, that's a nutshell what I have to say about a real estate part. Some of the concerns that I've seen brought up in the TSP group over the last quarter. As you see from this report here, I'm very upbeat on how things look over the next year. I think share prices are significantly below where they really should be, and they're due for a pretty solid bounce once all these geopolitical issues resolve themselves. And I expect to see more growth over the next year on top of what they're already down by. So I would absolutely stay heavily in stocks if you can. And like I said, if you can't handle having that much in stocks, maybe at least be patient, wait for them to get back up to what I would consider a more reasonable price level, and then go ahead and make your move to scale back to a more diversified and less volatile type of position, like that 75-25 distribution I talked about. That's all I have for now. Also, if you didn't notice, I'm putting this on a new YouTube profile because I'd like to separate my TSP investing type of content from my trucking and other personal kind of content. Because I actually found out from another YouTuber that YouTube highly encourages this actually. So each of the profiles on YouTube is more relevant to a certain type of content. So I'm gonna have this. I'm have my own new profile set up for just for the TSP and investing content, and that way those of you who are more interested in the TSP content and not so interested in my trucking type videos don't have to see the trucking videos, and then you'll have more relevant hits as well. And then also for the people who were on my who were more interested in the trucking content on my normal page, can they can see only trucking content and not worry so much about content that is not of so much interest to them. Anyway, that's all I have. I hope you all had a great, happy, and safe New Year last night and today. I am currently in Las Cruces, New Mexico, taking a break. I'm on my way back to Southern Cal myself. So hope you all enjoyed this presentation, and look forward to hearing from more of you again. So yeah.